Good morning, everyone. Thank you for joining this web conference with Lyxor Asset Management. I'm Tony Todd at Rumeur Publique, Lyxor's communications partner. Today, we're going to be going over the results of Lyxor's Active Passive Navigator review of 2020. We're joined today by the authors of this research, Vincent Denoiseux, Lyxor's Head of ETF Research and Solutions. Good morning, Vincent.
Good morning, Tony.
And we're also joined by Jean-Baptiste Berthon, Lyxor's Senior Cross-Asset Strategist. Good morning, Jean-Baptiste.
Good morning to everyone.
Before we begin, to the right of the screen in YouTube, you're going to see a chat box where you can post comments and questions. I'll be putting these questions to the speakers at the end of the web conference. You do have to sign into YouTube to post your questions, so if you're not signed in, please do that now. Thanks very much. The Active Passive Navigator looks at the main trends that influence global market performance and alpha generation by active managers during 2020. The volatility that we saw in markets was the ultimate test for active managers, and we're going to hear from Vincent Denoiseux. Most equity active managers passed that test with flying colours, and a very large proportion of them outperformed in 2020. It wasn't the same picture in the fixed income universe, and as we'll hear from Jean-Baptiste Berthon, it was a slightly more challenging environment. To start us off, I'm going to hand over straight away to Vincent. Vincent, if you could give us an overview of the Navigator and tell us, how did equity managers do so well in 2020?
Thank you very much, Tony. And once again, good morning to everyone. Thanks very much for your time today. 2020 has indeed been very eventful. And as you can see, once again, we are presenting the Active Passive Navigator from home, pretty much like a new normal. And as you mentioned already, Tony, financial market in 2020 have been quite unique. But before going into the details and the results, let me draw a quick map on how we're going to divide this presentation. So we're going to cover pretty much 5 sections. I will start with a quick overview. It's a previous slide. A quick overview of the methodology and shed some light on how we are looking at the active managers. Then I will delve into equities, as Tony said, look at the various equity subsegments like large cap, small cap, and so forth. GB will cover fixed income, JB will cover fixed income. And I will present a few insights about the performance of ESG funds and what about the long term. And last but not least, Jean-Baptiste will draw an outlook for 2021. But let me say a few words about methodology and how we look at this topic, which is the theme Lyxor has researched for many years. So this topic, first of all, it's very much at the core of the asset management industry and a source of intense and probably sometimes heat and debate between market participants. So, and as such, it has been heavily researched by the investment community and academics as well. So we can see 2 main streams. Overall, there is short-term perspective, so i.e. explaining how managers in the short term have been able or not to deliver outperformance. It's about analysis, regressing performances against factors and so forth. And we'll try to show you a bit of these results. Crossing these informations with Lyxor's views and forecasts, this enables us to form a projection and a forward-looking perspective on this debate. And there is as well a longer-term perspective, probably a bit more academic, where it's really about the long term, 5 to 10 years. So it's a lot of numbers, tables, statistics about heat ratio, excess return, and so forth. And why do we want to show these two aspects of the same debate? It's probably because it addresses 2 very different time horizons for investors, and we want to help them in forming their own judgment. So how we do that? So we look at a broad suite of funds. So I think we start with probably more than 80,000 funds. And then we drill down, we put them into categories. We compare with them with benchmarks. So we select as a benchmark the financial index we want to compare them with. To be fair and to be reasonable when we look at their performances, we deduct from the index the average total expense ratio that we observe on the ETF landscape. So i.e. we know what we are comparing the performances with, the benchmark, and we deduct the fee, so that we call the net benchmark you will see in the research report. If you want to follow that across the year, we provide that on a quarterly basis. So yeah, a lot of, if you want to go to the details, yeah, you're more than welcome. There are a lot of details for each asset class. But let me first draw a quick reminder about what happened in 2020. So pretty much irrespective of the asset classes you're contemplating, the story for 2020 has been very much similar, to be fair. It's a V-shaped scenario. So just for sake of reference, we've put S&P 500, Eurostock 50, and Nikkei on the left-hand side. So you can see massive directionality of the market, V-shaped scenario, but beyond this directionality, what has been crucial is the volatility of the markets and the dispersion, as we will see. The main factors that had a strong impact on active managers, on equities, it's about sector, country, and factor dispersion, as well for single stocks. And across segments, as we will see, many equity managers have outperformed. Across most of the asset segments, most of the equity managers have outperformed. Among others, the shining star for 2020, definitely small caps, and as well European large cap, as we will see, whilst US and world large cap have continued to suffer. It has been a quite tough stream for these two asset classes across the years. Let me start beyond the visible market performance that we just looked at, so performances of indices. There are a couple of parameters that we continuously monitor to get some sense of the market and really try to analyze what is really happening. And as you will see, some are evolving pretty much in the similar fashion, but each provides a different prism, a different perspective on the markets. So on the top of this dashboard, you have the flows. So it's worldwide equity flows, open-ended and ETF, open-ended fund and ETF. If you look at the right-hand side, that's 2020. It's a long-term chart, and it's from 2007 to 2020. When you look at the light pink bars, that's open-ended funds. So that's non-ETF, so essentially the traditional funds, including the active ones. You can see quite a few negative bars in 2020. We know it has been a tough year, initially at the start of the year for equities, and we got some outflows. But when you compare them in the light of 2008, typically, it has not been a cataclysm, if you wish, a catastrophe on the markets with regard to equities. And interestingly enough, on the top chart, so the dark pink bar chart, line bar, it's the ETF flows. And you can see in November, it has been historical record with regard to inflows into the ETF. So just a quick consequence, clearly, this year, through this year, the interest for ETF did not vanish definitely from an investor perspective. So, but if you look a bit on the bottom of this slide, you have essentially three technical indicators. From left to right, you have implied volatility of the S&P 500. You have actually three indices. On this one, you can see this bell-shaped scenario. So essentially, what is implied vol? It's essentially a thermometer for the stress of the markets. And you can see this bell-shaped curve. The volumes that we've seen on the equities, on the S&P 500, has broadly followed the same pattern. So volumes have accompanied essentially the crisis. There have been more volumes. They spiked during the crisis, sorry. And on the right-hand side, a slightly more technical indicator, it's what we call the liquidity. Why is it important to look at liquidity? Because when you're an active manager, you're rotating your portfolio. You're buying stock, you're selling stocks. Liquidity is what we call the bid-offer spread of the stocks. It's essentially how much it costs you to rotate your portfolio. And as you've seen, in March, you have this bell-shaped curve as well. So it has been tough to rotate portfolio, or at least it has been costly for active managers. So a bit of a mixed picture when you look at these metrics, but you can see that this bell shape has announced the fact that the market has clearly eased massively in the rally. So how did it work for active managers? So let me first recap. I mean, what is the recipe for active management, if I may? So essentially, active managers, they need two things to outperform. They need opportunities and they need skills. Opportunities, what does it mean? It means typically like differences in valuations or stock momentum. You're buying the stocks that outperform and so forth. No opportunities, no alpha. So we can measure opportunities using breadths. So typically indicators like dispersion, so the differences in performance. And let's be honest, if you have only opportunities, it's not enough. If you want to make active management, if you want to make active performance, you need skills. So essentially, the outperformance of the market is essentially a combination of skills and opportunities. So on this chart, on the left-hand side, it's essentially the measure of the opportunities we've seen on the markets. If we can maybe see the chart, that would be very useful. So it's on the left-hand side, you will see, thank you very much, you will see the dispersion that we have observed between sectors and countries. Let's take the example of countries. We have seen, so COVID crisis, we have seen the virus spread starting from China, so essentially from east to west, and gradually reaching Europe, then the US and the rest of the world to reach a pandemic status. So overall, financial markets, they attempted to price the timing of this expansion. Following this crisis, we had the impact of the economic activity, and which has been very different depending on how the crisis has been managed in terms of political, organizational, or economic impact which have been put in place and so forth. So the answers of the countries have been very different, and it has been reflected in their market performances. So in short, there has been dispersion between sectors and between countries. Sectors, like we've seen, we are doing this press conference from home using technology tools and so forth. So we have seen the impact of technologies, and we've seen as well the loss of energies, oil and gas stocks typically. So there have been many opportunities for putting in place sector rotation strategies. So between countries, between sectors, a lot of dispersion have happened. And what is the consequence of that? Then the question I was referring to skills, and let's be fair, on the right-hand side, you can see that there have been skills on the European large cap manager side, and the story has been broadly similar across quite a few different active managers landscape, if you wish. So if we can maybe just move to the next one, to the next slide. Yes, thank you very much. On the right-hand side, in pink, light pink to dark pink, you have the performances across 2020 of the active European large cap managers. Each ratio, one number to remember, 66% on European large cap. What does it mean? 66% of active managers have outperformed their benchmark. The benchmark is in blue. You can see that it's very much in the bottom of this chart, which is, of course, for active managers, a good news. So overall, they have been able to capture the increased dispersion that we have been observing on the market. It's not true for US, it's not true for large cap, but yeah, let's be fair, it has been a great, pretty much a great year for, in particular, to European large cap equities.
Thanks very much, Vincent. So a great year for large caps have we seen. You mentioned earlier that small caps had done even better. Can you tell us why that is and by how much?
Yeah, sure. Thanks, Tony. Small cap, as you said, have enjoyed a tremendous year in 2020. They've been really the bright spot of active. And why that? So how can we compare small cap and large cap? Essentially, one of the main differences is that small caps are less covered, less analyzed, with probably what we call technically less arbitrage on the markets, arbitrages on the market. Why that? Because they are less liquid. So not all investors can have access to them in massive quantities and so forth for large funds. So small cap is a very, very particular segment of the market. And as we've seen, there has been a lot of dispersion, so a lot of opportunities for active managers. To simplify, large cap managers have been able to capture them in a pretty nice manner. US small cap across the board, so from US to world to European small caps, UK small cap exceeding 10% of excess return. They have been able to utilize these opportunities and put them into action. So finding single stock, finding sector rotation themes, and so forth. So on this chart, on the left-hand side, you have the US small caps, which has done 62% hit ratio. To be fair, it's nearly the least that we've observed on the small cap segment. So really very, very strong asset performance generation. And I will show you a recap after. What is interesting is they have been able to cushion the loss of the market. So essentially being invested in in themes which have outperformed during the crisis. But even more so, they have been able to keep a high beta on the recovery of the market. You can see the pretty steep curve on the right-hand side, which is showing you that, yes, the benchmark was running very, very fast, and they've been able to keep their ground on that field. So in terms of summary, you have, as you can see, we like numbers at Lyxor. We have many numbers everywhere. So if you want more, please have a look at the research report. How do we measure that? So on the left-hand side, you have what we call the hit ratio. So once again, it's essentially how many active managers have outperformed on their own asset class vis-a-vis what we call the net benchmark, so i.e. benchmark deducted from the average ETF fees. Left-hand side, ranging from 16% US large cap growth. So as you might remember, which is an asset class that has been a rocket, which skyrocketed, very, very tough to catch the rally of this market, up to 91% on the Europe large cap value, which is definitely not the outperforming asset segment in absolute terms. But once again, we are looking at relative returns here, really outperforming a benchmark. So overall, across the board, many numbers above 50%, which is definitely a positive news for active managers. On the right-hand side, it's essentially the same picture. It's what we call the excess return. So we do the average of the difference between the active managers and the benchmark. Overall, to make the story short, very strong performance for European large caps. On average, positive results for many of the asset classes. And the less rosy picture has been for US and world large cap, which are still very large segments. You're looking at massive AUMs. But let's be fair and well done on the equity side. Back to you, Tony.
Thank you very much, Vincent. It's been an extraordinary year indeed. Some remarkable performances, a bit of a mixed picture here and there. I'm sure that in the audience you're going to have some questions for Vincent. So just a reminder that you can post your questions in the chat box to the right of the screen just here. Thanks very much. Looking forward to receiving those. Looking at the fixed income universe, we're going to hand over here to Jean-Baptiste Berthon, Senior Cross-Asset Strategist. Fixed income presented a different picture to equities in 2020. Perhaps investors were better off with passive. Jean-Baptiste, can you give us an overview and tell us where things went right, where things went wrong?
Yeah. Yes, indeed, last year was clearly a rough ride for most fixed income managers. You may remember that global growth was starting to pick up early 2020, when managers suddenly faced a collapse in yields and also a major credit crunch. So it was clearly a bloodbath for sovereign funds relative to passive products, while high-yield managers actually were more resilient thanks to their cautious exposure. We find that the ranking kind of switched over the second part of the year. Those that outperformed during the crash tended to lag in the rally and vice versa. And so over the second period of the year, EM managers really shined. And we also find that US sovereign funds, as well as global aggregate funds, did pretty okay. The ones that have really disappointed in H2 were the high yield managers. But I suggest we zoom on how they did over the second part of the year, starting with the sovereign funds. So the story was actually quite different across the Atlantic. US managers regained some of the lost ground over H2. They successfully played the steepening of the curve. They turned long inflation. They also went for yields in securitized product and in higher yielding municipals. That's how they navigated this environment. And we find also that US and global diversified funds made similar moves, which helped them perform decently. In contrast, managers in Europe clearly struggled. There were multiple false starts, which killed their opportunity set. To take a few examples, the economic rebound, which started to create to spur some trends just after the end of the lockdowns, was cut short by the second virus wave, which quickly intensified. Second example, the enthusiasm regarding the recovery fund, which was quickly faded by the laborious political process. And finally, one reason for the underperformance in Europe was the fact that there was very limited dispersion across countries, across periphery countries, really few things to play. So that's for the sovereign. And if we move to the high-grade active managers, they ended broadly on par with their benchmark. Clearly, the deep credit spread tightening was tough to beat, although more so there was a little differentiation across sectors. However, we find that US managers generated alpha ahead of US elections. Typically, they favored issues that would benefit from a more ambitious Democrat reflation, and also they positioned on more infrastructure spending. And in Europe, we find that the way they navigated markets was to increase their risk to cyclical sectors, and they also correctly played the Brexit, positioning through, for example, Irish issues on confidence that some kind of a last-minute deal would be found. So yeah, they ended broadly on par with the indices. Now, the ones that disappointed in the second part of the year were the high-yield managers. The very aggressive compression in credit spread was clearly challenging to match, and it took place with quite limited dispersion across mainstream segment. And we find that the true opportunities actually were, especially after the vaccine announcements, were actually in riskier issues, in longer dated paper, lower rated paper, lagging sectors, these type of segments. But unfortunately, managers were overly cautious, favoring more medium-term duration and also safer crossovers. Crossovers are what we call this is the label for all the issues that stand in between high grade and high yield, which tend to be to deliver less yield but have less risk. That said, so for high yield managers, to be fair, it was clearly not an obvious choice to add risk at these level of spreads, and also amid the quite large supply of high yield issuance to digest. But yeah, clearly that was the strong negative spot over H2. In contrast, looking at EM debt managers, this was really the bright spot. They really outperformed over the period. They were right on their market timing. They raised their exposure. They moved lower in quality. They allocated more to corporate issues instead of pure sovereign issues, which tend to be riskier but also more profitable. So good market timing, but also good credit picking. They've been arbitraging diverging inflation and stimulus trends in EM countries. For example, they picked Chinese bond issues, for example. They also interestingly, they also successfully, moved to EMEA region, including Turkey, South Africa, and this was made at the expense of Asia. And this was actually a good move and counterintuitive, because Asia was a more solid region in terms of macro backdrop, but so they made the right call on that, taking more risk. And lastly, they reinforced their frontier exposure, comforted by improving macro prospects. So overall, they outperformed their benchmark by around 2%, which is very significant over the period.
Thanks very much, Jean-Baptiste. And just another reminder that you can put your questions in the YouTube chat box up here, or you can email them to me. We've received a few by email, tony@rumeurpublique.fr. Jean-Baptiste, can you give us a summary of the fixed income picture?
Yes, maybe the summary for the whole year now is clearly the remarkable outperformance of EM debt managers, while performance were clearly milder elsewhere. The second interesting conclusion we take from that is that we again verify this kind of rule of thumb for fixed income managers, that sovereign and high-grade active funds tend to add more risk in their portfolios with a view to differentiate from their benchmark, which makes them better in bullish phases. And in contrast, high-yield funds tend to favor safer positioning to manage their risk, obviously, but that makes them more appealing in darker times. And so we again verified this last year.
Thanks very much to Jean-Baptiste, and thanks very much to Vincent as well for your presentations. What lessons can we learn, both of you, from 2020 as we look ahead to 2021? How is the context, which is still very challenging, evolve as we go into the year? And how can investors and managers generate alpha? Vincent, for you, what are the highlights? What's your analysis for the coming year, looking ahead?
Sure. Yeah, maybe let's make a wrap-up of what we've seen in 2020. So we have seen strong outperformance on many equity active segments and mixed performance also on the fixed income side. So let's try to put that in comparison with the last decade. So what we did here is we took the excess return generated by active managers in 2020, 2019, 2018, and so forth over the last decade. And we are comparing the alpha, not the performance, and so the excess return, so the quantity of performance they have added or subtracted somehow from the benchmark. So yeah, when you put all the numbers together, you can see from left-hand side that's the most outperforming asset class in 2020, to the right-hand side the most underperforming one. You can see the small cap, which are a shining star of 2020. That's the light blue bars. And in dark, you have the average over the last decade, which is clearly less rosy, probably. So what we can say is that if we start counting the asset classes which have been better this year compared to last decade, we pretty much have 3/4 of the asset segments which have at least been better than what they have been in the past decade. So I think it's a quite remarkable exercise, quite remarkable result. Sorry. So in the sense that clearly 2020 we can broadly speaking of a pretty nice year. So that was probably the first summary I could write, I could make on this one. So the second kind of exercise I wanted to go through is essentially going through the performance of the rising star in the last 2-3 years. It's definitely ESG. So within Lyxor ETF, within a publication called Money Monitor, we reported record flow last year on ESG ETF, even exceeding the non-ESG ETF flows. So, but it's not only about flows. It's not only about ETF either. The ESG themes has embraced the entire investment community. So we'll publish much more granular perspective on this going forward. But what we did here is we looked at each asset segment and for which we have more than 25 funds. Otherwise, the stats would not be that meaningful. And we essentially look at the performance of the ESG funds, so as per Morningstar, and compared their performances, so the equal weighted performance of this ESG fund compared to the asset segment, to the peer group of this asset segment. What we found is that, pretty nicely, if I may use this term, the ESG fund have pretty significantly outperformed across the board. So from investment grade bonds to large cap equities and so forth. So what is interesting? So the average number is 1.4% excess return on top of the peer group. And what is interesting is that it's not only about active fund, it's really about the ESG characteristic, if you wish. So it's a broad investment landscape. So you have climate, you have impact, you have exclusion, you have best in class, you have many, many different types of methodology. But when we look at the indices and when we look at the active funds, we have essentially 3 main factors which have fueled this outperformance over last year. The number one was the overweight to tech. Which, as we know, has been a great performer last year. We are doing this press conference in a very much remote environment. So outperformance coming from the overweight to tech, definitely. Another point worth mentioning is the underweight to oil and gas. climate funds typically are reducing significantly or even excluding for the most impactful, if I may use this term. So the underweight in oil and gas has been had a very, very strong impact on the performance as well. And last but not least, if you look at the ESG stocks, so i.e. the stocks which have a larger score from an ESG perspective, we can see a strong correlation with what we call the quality style. So factors that essentially embrace the quality of the stock. So usually associated with lower volatility of earnings, lower leverage, and so on. So this factor in particular has outperformed strongly during the crisis. So for the three reasons, and of course there are some stock picking and specific stocks which may have outperformed. But yeah, if we try to summarize what happened in 2020, these three factors have been definitely key for ESG to outperform. Overall, strong outperformance for ESG funds. So now, I've been very positive, as you may have heard, about 2020. I will have a slightly different angle now, and I will take a slightly longer term perspective when it comes to invest into active funds. So what I'm going to do now is I will not look at last year, but I will look at the last 2 years. So what does it mean? Here, each dot is one fund. You have the horizontal axis, the x-axis, 2019 excess return. So right-hand side, what has outperformed in 2019. 2020, that's a y-axis. So what is on top of the chart is essentially what has outperformed last year. Give or take, I think, yeah, top of my head, it must be 36% for world large cap. It's all world large cap funds. And if you're an investor into one of these funds across these 2 years, i.e. 2019 and 2020, you're essentially looking at the top right-hand corner, so which is in fact 12%. What does it mean? It means 12% of active management across the board in world large cap European domicile fund, only 12% have outperformed. Let's be clear, it's a bit of a disappointed result. But that's the way it is. And in fact, it tells you how difficult it is to consistently have the right portfolio across the market cycle. So essentially, to be agile and be able to change from one style to the other one to continue outperforming across market cycles is still a complicated endeavor. So how do we compound that across the long term? So that's the next one. You will see it's a fairly theoretical chart because it's very long term. It's 10 years. So, but what we do is essentially the same thing. So we take all funds, their monthly return across time over the last decade, and we look once again at world equity large cap. Pink, light pink, the bottom decile, dark pink, top decile, and once again, same color, the benchmark is in blue. As you can see here, the benchmark is right on top of the chart. Okay, but let's don't be negative right now. We are looking at a stellar performance of equities. So the key message from this chart is, yes, you should have bought equities, definitely, over the last 10 years. 150% and even more than 150% cumulated over 10 years. You should, investors should have been quite opportunistic on equities, on equity world large cap. So that's absolute return. But when you can see such a, not systemic rally, the term is badly chosen, but overall such a sustained rally, such a consistent rally over the decade, it has been tough to maintain a beta, what we call the beta, so the exposure of the fund as high as 100%. So when the market was going down, many active managers, they want to protect their portfolios to reduce a bit on the downside and so forth. And then, wow, you get this V-shaped scenario once again. So it has been tough to keep up with the pace of this rally. And you can see that over time, it has led to fairly disappointing result. So how to navigate through essentially a pretty nice picture of about 2020 and such a more mixed long-term picture, I think it all depends on your time horizon for investors, on how they invest. So for how long they are looking forward, which is their time horizon. And the second point is really how they build their portfolio and how they construct it. If they are agile enough to switch between style, between active managers and be dynamic and rotate their portfolio, then it's great. We can see that 2020 provided them with alpha. On the reverse side, if they clearly want to have long-term, a bit more static returns and taking just essentially the equity risk premium, then in that case, then the ETF, so index products, can be of interest. That was for this recap, Tony.
Thanks very much, Vincent. As we can see that despite the massive performance in equities, securing consistent alpha has been a challenge. It's going to carry on being a big challenge. Very interesting what you were saying earlier about the stellar performance of ESG funds. We've had a few questions emailed in about ESG, so we're going to come back to that later on. Jean-Baptiste Berthon, what is your outlook for 2021? What are the challenges and opportunities that you see in the year ahead of us?
Maybe a long story short, we think that while macro fundamentals will normalize over 2021, trading conditions will actually remain quite atypical and require a very tailored combination of active and passive products. But I will get back to that. But in more details, we think that, yes, we are exiting a recession. The recovery will accelerate based by vaccination. Stimulus and liquidity will remain huge, and some savings will start to be put back to work. With Brexit and bold trade tactics from Trump's now behind, we think that fiscal redistribution, will be the main policy uncertainty. And all of this will unfold at a time when the distortion from record stimulus and the threats from rising inequalities everywhere, inequalities across blocks, across countries, across labor, and so on, all these threats will not immediately surface. So clearly, apparently a rosy picture, but we actually expect trading conditions to be a lot more challenging for 4 reasons. First, we think it will be very difficult for managers to get the right timing of regional and sector recoveries. That will be tough. Second, managers will have to navigate rich and crowded assets, which will regularly create some bubbles. The extreme liquidity will require very close tactical monitoring, both ways, on the way up and down. And typically, the recent short squeeze attacks or the rush on silver are events that we think will be recurrent this year due to excess liquidity. And you can see the chart on this slide, on the left side, which reflects how investor sentiment evolves versus their positioning for a number of markets. We couldn't add them all, but to keep it clear. But what you see there is that they tend all to err now on the more vulnerable bottom left quadrant, which requires some monitoring. So clearly, tactical monitoring will be key for managers. Now, a third reason why it will be complex is that managers will struggle to protect their portfolios amid the grounded yields. A majority, we think, will be forced or will choose to keep diversified allocation, which will make, in turn, it more difficult for them to stand out versus their benchmark. And probably a last important reason is that there are still very significant risks that could flip the board very easily. It's very easy to imagine a more aggressive virus variant resistant to vaccine. To some extent, also intensifying inflationary pressure could add some pressure on the market. So we think that these 4 reasons means that we will not be back to normal in 21 for market trading. Now, if we try to sort out what will be supportive or not for active managers, let's start off with the positive side. Clearly, asset dispersion, as Vincent described for equities, but asset dispersion, one factor that is crucial for alpha, will stay high in our view, and this will mirror uneven vaccinations, and uneven policy choices across countries. We also expect a wider set of investment themes as the ones that we are focusing strictly on the pandemic will start to abate. So more themes. And also, we think that the economic normalization will lead investors to focus more and more on micro fundamentals, the health of individual stocks, issuers, etc. And this would lead, in our view, to greater asset differentiation. Now, that said, there will be clearly some constraints for active managers. Flows and liquidities obviously will generate huge valuation distortions, which will be a challenge for fundamental approach. Market timing will also be very tricky, given the bubbles that will mushroom over the year. It will not be all that bad, actually, because this will also open a number of buy on dips opportunities, but clearly a riskier environment. And finally, managers will have to choose between diversification, but poor alpha, or bolder moves, but at a higher cost of risk. So that's probably the main features for 21, and the implications for the active versus passive investment products. We think that typically, in terms of outlook on the active side, on our side, we would concentrate on assets that do offer a structural alpha advantage due to a lack of coverage, inefficient pricing, and we think that this typically include small cap, EM managers, Japanese managers to some extent. On the active side, we would also favor regions that are undergoing clear macro trends, opening relative value opportunities. This includes, for example, Asia, with a number of trends, China recovering, the rest of Asia capturing part of the export imports and so on. So clear macro trends which are exploitable. And lastly, for active, we would pick the assets that are overheating. Typically, active managers tend to be more better risk managers than passive products. And typically for China, the tech sector, this would be an interesting choice. Now, on the passive side, we think that we would start with the most efficient market, and we clearly have in mind US large cap, world large cap, to some extent high grade also managers. We think that on these asset class, very efficient, passive is more interesting. And we would also pick market segments that are lagging, thus prone to greater directionality thereafter. And this include, in our view, value issues, the UK market also, which could be more interesting. So that's where we would favor a passive investment. And lastly, we think that assets which are sensitive to a secular trend, but that is not offering enough market depth, are also appealing for passive. That clearly include green energy, for example, digitization of the economies. We think that passive are more interesting in that area.
Thanks very much indeed, Jean-Baptiste. So lots of arguments for active, lots of arguments for passive, and lots of challenges and opportunities on both sides of the story. Before I ask you both, Vincent and Jean-Baptiste, to sort of give me a summary and tell me what your key highlights are, just one last reminder that you can ask questions either in the chat box or by emailing me, tony@rumeurpublique.fr. So, Vincent, perhaps I can hand over to you. What, for you, are the biggest takeaways of the year? What are the most important things to remember from 2020 as we go into 2021?
Yeah, sure. Thanks, Tony. I mean, the conventional wisdom is that active managers aim to protect portfolio performance during periods of heat and market volatility. And let's be clear, that's what we've seen in 2020. So there was a strong challenge for active managers to prove their worth during these times. And I think Yes, on the equity side, the picture has been to be fair, has been really positive for them, especially when it comes to small cap across the board. Europe and large caps, it has been more complicated for US and world large cap equities, and the key word was really sector and country dispersion that fueled this alpha. On the fixed income side, as Jean-Baptiste mentioned, yeah, in quite a few of the segments, passive would have been could have been a better opportunity for investors, with a very, very clear stellar performance of emerging market debt active manager, which strongly outperformed their benchmark, as well as global fixed income. So as we've seen, the long term is a bit more challenging when it comes to alpha generation, to the sustainability of the alpha. So over a long-term horizon, it's still quite complicated to generate sustainable alpha for active managers. So at the end of the day, the point is really about the investment horizon, number one, and essentially the investment philosophy, number two, of the active manager. Of the manager, for a long-term investment into a liquid asset class like Jean-Baptiste mentioned, US large cap or large cap, then definitely passive investment vehicles like ETF can provide really useful in this situation to build a long-term exposure. When it comes to less liquid asset classes, then there are opportunities for active managers, definitely. So ultimately, it reminds us from a portfolio construction perspective that such a volatile market reminded us about the importance of fund selection and the need for a really robust asset allocation framework to keep the right positions, because you can always face a V-shaped scenario, and then you really need to be very agile with your portfolio on an ongoing basis. Jean-Baptiste, you wanted to finish on the alpha prospect?
Yeah, maybe in terms of summary for the year, on the fixed income side, clearly we see the strong outperformance of EM managers, whereas most other styles tended to suffer. Now, in terms of alpha expectation, as mentioned earlier, we think that the trading condition will remain highly atypical over this year, even though the macro environment will kind of normalize. And we think that the implication from that is that it will require quite a lot of strong selectivity in terms of combining active versus passive products. And as mentioned, in terms of active, we would only concentrate on the ones that truly prove their ability to produce sustainable alpha, typically the asset classes that are less arbitraged, and also the ones that are too expensive, overheating, the ones that are going through macro trends. And now for passive investment, we would start with the most efficient market, use them for lagging assets, use them in secular trends.
Thanks very much, both of you. It's been a very interesting presentation. The balance between active and passive needs to be well thought out. Equities did very well in 2020, and there are still plenty of opportunities in 2021. I'm going to move over to questions now. I've received a few by email, quite predictably, perhaps with a big focus on the ESG, Vincent, which you touched on during your presentation. I've got a first one here. To what extent has ESG product performance been driven by the technology sector? And to what extent should investors be concerned about the risks arising from over-concentration in this sector?
Yeah, that's a good question. So yeah, clearly the tech exposure has been pretty strong, but I would not say it has been stronger than the underweight typically when it comes to oil and gas. So I think it's really about, and to be fair, the strategy are quite well differentiated. If you look at active manager, passive manager, and then if you drill down manager by manager or index by index, you will see a pretty diverse landscape of ESG. As I mentioned, you have exclusion product, you have product which overweight the others, the scoring are not the same, the size of the portfolios are not the same. So with regard to your second question, with regard to crowding, it's a topic which we covered quite extensively when smart beta and factor investing was continuously raising a lot of assets. We got the same questioning along this crowding point. I'm not afraid, because to be fair, right, rather than a real overweight, underweight, I think ESG is starting to have a real impact on the companies themselves. So i.e. there will be more ESG. The scores, I think, from an ESG perspective, the score of I suspect, I'm not the ESG analyst expert, but I suspect the ESG scores of the companies themselves will improve. So you will see a real impact. So overall, I think we're going to see positive development on the company's front, which should dampen quite significantly the risk of crowding in a few selected number of companies.
I've got a similar question on ESG. Perhaps Jean-Baptiste, you can answer this one. Will investors have to think carefully about the impact of ESG? Does it risk to be overblown? And we were talked about overcrowding just now, but are we going towards an ESG bubble? Is there too much noise about it? What are the pitfalls that investors are going to have to look out for specifically on ESG?
Yeah, maybe we discussed that many times with Vincent. Actually, this is clearly a key question. In our view, we think that the flows rushing into this segment are only at the beginning. So it's very clear that this will improve, and the market size will improve. So a bubble, not sure we can label that definitively like this. The second aspect, which we think is important, is that while initially companies focusing on clean energy and so on tended to be unprofitable, depending on subsidies and so on, we find that now they are starting to be to make their own profits and are more autonomous and are making some profits. And so we think that it's hard to call this asset class a pure bubble in this condition. So the answer, the short answer would be probably not a bubble yet.
Thanks very much, Vincent. Right at the beginning of your presentation, you talked about the incredible performance of equities in 2020. And I have one question here that last year was amazingly good for active managers in equities. When is that rally going to run out of steam, and what are the indicators that investors should be looking out for as equities continue to overperform? What indicators should investors be looking out for when that rally finally ends?
Yeah, I think if your question, if I may, if your question is rather about the equity performances that we can expect for 2021, I'm happy to leave the floor to Jean-Baptiste. I can address the active part if you wish. So clearly, as I said earlier, so for an active manager to outperform its benchmark, you need two things. You need opportunities and skills. Opportunities, skills, they are what they are. Opportunities, we measure them pretty precisely in terms of dispersion between sectors, country, style, and even single stocks, so i.e. to find single stock opportunities. So that addresses the metrics that we look at when it comes to active generation. And I leave Jean-Baptiste cover the outlook for more the equity, so the performance we expect from equities.
Yeah, on the first part of the question, I think the one of monitoring all the business cycles for the key region, we find that for now it's slightly positive. So in case of doubt, we think that investors should be long equities structurally. Now, the key aspects in our view to monitor, which is actually very complex at this time, is really the tactical environment, positioning, sentiment, flows are the key indicators in our view. And the difficulty currently, even for we have many models tracking this internally at Lyxor. The difficulty is that the liquidity is such that it can we could be too overly cautious on markets, and so we are trying to keep in mind that tons of liquidity will have to rush in markets. And so traditional red flags that would come because of the valuations, because of the position in futures or options and so on, we should make sure that we are not overly cautious. But yeah, I think the tactical environment will be the key indicators to look at, probably even before the macro environment, which is fine.
Thank you very much, Jean-Baptiste Berthon, Senior Cross-Asset Strategist at Lyxor Asset Management, and also Vincent Denoiseux, Lyxor's Head of ETF Research and Solutions, for this presentation today of the Active Passive Navigator for 2020. Thank you also to everyone who's joined us for the live today. Looking forward to hearing back from you all soon. Thank you very much, and goodbye.
Thank you. Bye.